Here's a dinner party story from last month. Guy in his mid-50s, sitting across from me, casually drops that his neighbor just retired with $4 million. Then his brother-in-law chimes in, also retired, $3.2 million. Then someone mentions their aunt, $2.8 million. And I'm sitting there thinking, either I'm at the world's most statistically improbable dinner party, or someone's math is very, very wrong. Because here's the actual number, 3.2%. That's how many American retirees actually have $1 million or more in their retirement accounts. Not 4 million, not 3 million, 1 million. And 97 out of every 100 retirees don't even hit that. So either everyone at that dinner table was lying, misremembering, or confusing net worth with retirement accounts, which, spoiler alert, they absolutely were. This is the gap I want to talk about. The gap between what you think is normal for retirement savings and what's actually normal. Because if you're sitting on $600,000, $800,000, even $950,000, you probably feel behind. You probably read headlines about people retiring with multiple millions and think you've somehow failed. And that feeling, that anxiety, it's based on a completely distorted view of reality. So I'm going to show you exactly where you actually stand, why the numbers you see everywhere are misleading, and what it really takes to hit 7 figures. Because the psychology here matters more than the math. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Let me give you the central image that explains this whole thing. Imagine American retirement savings as a massive pyramid. At the very top, there's this tiny platform where the $1 million plus crowd stands. That platform holds 3.2% of all retirees. It's small, it's exclusive. It's harder to reach than you think. But here's the problem. Financial media puts a spotlight on that platform. Every article, every headline, every retirement success story focuses on the people standing up there. So when you look up from wherever you are on the pyramid, all you see is that lit up platform. You don't see the other 97% of people below it. You don't see the median retiree standing at the $200,000 mark. You just see the top and you assume that's where everyone is. This distortion has real consequences. When researchers ask Americans how much they think they need to retire comfortably, the average answer is $1.5 million. $1.5 million. That number didn't come from a financial calculator. It came from media exposure. It came from seeing the 3 million and 5 million stories so often that 1.5 million started to feel like the baseline. And now you got people with $1 million saved who feel anxious instead of accomplished. People who are objectively in the top 3% feeling like they're somehow not enough. Let me show you what actually normal looks like. The median retirement savings for households between ages 65 and 74 is right around $200,000. Not 2 million, 200,000. And median means half of retirees have more than that and half have less. If you look at households 75 and older, that number drops even further to about $130,000. These are the real numbers. This is where most people actually are. Now, you might be thinking, wait, I've seen different numbers. I've seen reports saying the average retirement balance is much higher. And you're right. The average does come in higher, around $669,000. But averages are useless here. They get dragged up by a small group of extremely wealthy households at the top. If 9 people have $100,000 and one person has $10 million, the average is over 1 million. But that tells you nothing about what's typical. The median is what matters. The median is reality. So if you have $1 million or more, you're not just above average. You're in a completely different category. You have 5 times the median retirement savings in this country. 5 times. And yet, I bet a lot of people reading this who have $1 million saved still feel behind. Not because the numbers don't work, because they're measuring themselves against the wrong benchmark. Here's where it gets really interesting. Let's talk about how people actually get to that top platform. Because it's not just about saving more. It's about who you are and how the system is built. Income is the single biggest factor. According to the Federal Reserve Survey of Consumer Finances, higher income households have an average of $769,000 saved for retirement. Middle income households, $79,500. That's not a gap, that's a canyon. And it's not because middle income earners are bad at saving. It's because the math of percentage-based savings is brutal. If you're saving 15% of $50,000 a year, that's $7,500. If you're saving 15% of $200,000 a year, that's $30,000. Same discipline, 4 times the result. The system rewards high earners exponentially. Education plays a massive role too. Households with a college degree have about 3 times more retirement savings than households with only a high school diploma. The median for college graduates is $141,700. For high school only, $44,000. And before someone jumps in with, well, that's because college grads work harder. No, it's because college grads have access to higher paying jobs, which often come with better benefits, including employer-matched 401ks. The game is tilted from the start. Now, let's say you did everything right. You had the income, you had the education, you maxed out your 401k contributions every year. How long did it take to hit $1 million? According to Fidelity, the average 401k millionaire took 27 years to get there. 27 years. That's not a sprint. That's not even a marathon. That's a career-long endurance test. You had to save consistently through the dot-com crash in 2000, through the financial crisis in 2008, through COVID in 2020. You had to resist pulling money out when life got expensive. You had to stay disciplined when every instinct told you to spend. And even if you did all that, you still needed the market to cooperate. If you started saving in 1997 and retired in 2024, you rode one of the longest bull markets in history. If you started in 2000 and retired in 2027, your timeline included 2 massive crashes in your first decade, which dramatically changes the math. Sequence of returns risk is real. Timing matters, luck matters, and nobody wants to admit that. So when someone tells you they have $1 million saved, what they're really telling you is they had a high income, likely a college degree, 27 years of discipline, and favorable market timing. That's not a common combination. That's a statistical outlier. Now you might be thinking, okay, fine, I get it. Most people don't have $1 million. But what about the people who do? How many of them are there? Because if there are millions of millionaires, then it can't be that rare, right? Let me give you the actual numbers. According to Fidelity, as of 2024, approximately 497,000 Americans have $1 million or more in their 401k. On top of that, nearly 399,000 people have at least that amount in their IRA. Now, there's overlap between those two groups, obviously. A lot of people who maxed out their 401k also maxed out their IRA. But let's be generous and say there are roughly 600,000 to 700,000 people in the US who have $1 million or more in retirement accounts. 600,000 sounds like a lot until you remember there are about 130 million households in the United States. That means roughly half of 1% of households are in this club. Half of 1%. And yet, financial media talks about $1 million retirements like they're the default. Like if you're not there, you failed. It's absurd. Here's a quick comedic aside. I was reading a financial blog last week, and the article started with, so you've saved your first $1 million, now what? And I'm thinking, who is this for? That's like a fitness blog opening with, so you've completed your first Ironman triathlon, now what? 99% of people haven't done that. 99% of people will never do that. But the blog assumes everyone reading is in that top 1%. It's not advice, it's performance. Let me tell you a story about a guy I know who works in finance, mid-40s, smart guy. He's got about $850,000 saved, which is incredible. He's in the top 5% for his age. But he told me he feels stressed every time he looks at his account. Why? Because his colleague, who's 2 years older, has 1.3 million. And instead of thinking, wow, we're both doing great, he thinks, I'm behind. I should have more. It's like running a marathon, and instead of celebrating that you finished, you're mad you didn't beat the guy in front of you. The comparison is the problem. But now, here's where it gets weird. Because even if you do hit $1 million, the goalposts move. You start thinking, okay, but what if I need 1.5 million? What if inflation is worse than expected? What if I live to 95 and suddenly $1 million doesn't feel like enough? This is the hedonic treadmill applied to retirement savings. No matter how much you have, your brain adjusts and tells you it's not quite enough. Let me give you a concrete example to show you what $1 million actually looks like in retirement. Let's say you retire at 65 with exactly $1 million. You follow the 4% rule, which is the standard safe withdrawal rate. That gives you $40,000 a year. Now add in Social Security. The average Social Security benefit for a retiree in 2026 is about $1,900 a month, or $22,800 a year. So you're looking at a total retirement income of about $62,800 a year. That's not rich, but it's also not struggling. For a single person, that's comfortable. For a couple, if both people have Social Security, you're looking at closer to $85,000 a year combined. That's a solid middle-class retirement. But here's the thing. That math assumes you manage it correctly. It assumes you don't panic sell during a market crash. It assumes you don't over-withdraw in the early years. It assumes you have a plan for taxes. And this is where most people screw it up. Because hitting $1 million is hard, but using $1 million correctly is harder. Let me tell you about two hypothetical retirees. Retiree A has $1.2 million. Retiree B has $900,000. On paper, retiree A is ahead, but retiree A has all of his money in a traditional 401k, which means every dollar he withdraws is taxed as ordinary income. Retiree B has $600,000 in a traditional 401k and $300,000 in a Roth IRA, which is tax-free. Retiree B also has a plan. He's going to withdraw from his traditional account up to the top of the 12% tax bracket, then fill the rest of his income needs from his Roth. Retiree A just pulls money out whenever he needs it and gets hammered with taxes. Over 20 years, retiree B ends up with more spendable income even though he started with less. Structure beats size. This is the part nobody talks about. Once you've built the money, the next game is optimization. And optimization is boring. It's not sexy. It doesn't make for good headlines. But it's a difference between a comfortable retirement and a stressful one. Here's another quick comedic cutaway. I once heard a guy at a barbecue say, "I don't need a financial advisor. I've got ChatGPT." And I thought, buddy, ChatGPT doesn't know your tax situation, your risk tolerance, or your spending habits. That's like saying, "I don't need a doctor. I've got WebMD. Good luck with that." Now, let's talk about what happens after you hit $1 million. Because the biggest mistake people make is thinking the hard part is over. It's not. The hard part is just different. When you're building wealth, the game is simple. Save more, invest consistently. Don't touch it. But once you have wealth, the game changes. Now you're managing sequence of returns risk. You're managing taxes. You're managing withdrawal rates. You're managing longevity risk. You're managing healthcare costs. And if you screw up any one of those things, you can turn $1 million retirement into a struggle. Let me explain sequence of returns risk with a quick example. Let's say you retire with $1 million in January of 2008, right before the financial crisis. The market drops 40%. Your account is now worth $600,000, but you still need to withdraw $40,000 to live on. So you're pulling money out of a declining account, which locks in losses and makes it much harder for your portfolio to recover. Compare that to someone who retires with $1 million in January of 2009 after the market has already crashed. They start their retirement at the bottom of the market, so every year after that is growth. Same starting balance, completely different outcome. Timing matters. This is why I'm obsessed with structure. You can't control the market, you can't control inflation, but you can control how you set up your accounts, how you sequence your withdrawals, and how you manage your taxes. That's where the real alpha is. So let's bring this back to the original question. How many Americans actually retire with $1 million or more? 3.2%. That's it. If you're in that group, or even close to it, you're doing something 97% of the country isn't. And if you're not in that group, it doesn't mean you failed. It means you're normal. The median retiree has $200,000 saved. If you have $400,000, you're doing twice as well as the median. If you have $600,000, you're doing 3 times as well. Context matters. Here's what I want you to take away from this. First, stop comparing yourself to the outliers. The $3 million retirement stories are not the benchmark. They're the exception. If you have $500,000, $700,000, even $900,000 saved, you're ahead of the vast majority of Americans. Second, focus on structure, not just size. A well-managed $800,000 portfolio can outperform a poorly managed $1.2 million portfolio. Get your taxes right. Get your withdrawal strategy right. Get your asset allocation right. That's where the real gains are. Third, understand that hitting $1 million is not the finish line. It's the start of a different race. The game after you build wealth is optimization. And most people are terrible at it because it's boring and requires actual planning. And look, I get it. It's hard to feel good about your retirement savings when every article you read is about people retiring with millions. But that's the game. Financial media makes money by making you feel inadequate. They highlight the extreme cases because that's what gets clicks. But the reality is, most people retire with way less than you think. And if you're in the top 10%, top 5%, or especially the top 3%, you've done something rare, you've done something hard, and you should feel good about that. Lazy investing built more fortune than crypto memes. Boring, consistent, long-term investing in index funds. That's what actually works. Not stock picking, not crypto, not day trading, just disciplined, automated, boring investing. And if you've done that for 20 years, you're already ahead of almost everyone. So here's the final thought. The next time someone tells you about their neighbor who retired with $4 million, just smile and nod. Because either they're lying, they're wrong, or their neighbor is in the top 0.5% of all retirees. And you don't need to be in the top 0.5% to retire comfortably. You just need a plan that works for you.